Insurance, one of those things that nobody wants to pay for it, but you're glad you did when you actually need it. Today, we're talking to Patrick Scully. He's an independent insurance broker, and he's somebody that insures a ton of properties for us. Today, he's going to give you the exact things you need to know about insuring your properties and insuring you and your family. Let's get started. Insurance, one of the most important topics, yet can be boring. Today, we are talking to Patrick Scully, and we're going to cover investors' insurance, specifically as it relates to flipping, as it relates to rental properties, liability, what can go wrong, how do you cover yourself. So, Patrick, welcome.
Thank you, Andrew. Appreciate the opportunity.
Definitely. So, Patrick, you are a owner-broker of a insurance agency.
That's correct.
Okay. And who are you with?
My firm is called Scully Insurance Group. We're a division of Robertson Ryan Associate, a national company. We are what's known as an independent agent, as opposed to a captive agent or a direct writer like a State Farm or an Allstate or an American Family Guy.
So for somebody that may not be in the know, what is the difference, right? Because we all know of, a lot of times it'll be like, well, he's an insurance broker, right? We use that term, and then versus, oh, he's a State Farm agent. So what is the difference between someone like you versus, let's say, a State Farm?
Essentially, it's the contracts in which we carry with the suppliers. We refer to them as carriers that provide us our product to sell to the public. I contract with a number of different carriers, 50, 60 different insurance companies. All have different appetites, provide different needs for different sets of customers. Then I bid that situation out to various carriers that have an appetite for that, and then bring to you what I feel to be the best terms in price and coverage. A direct writer will use a Allstate agent, for instance, who's got a storefront in the neighborhood. He provides insurance from Allstate and only Allstate, and he's under a franchise relationship with that company, and he provides their suite of products.
Got it. So basically, from a standpoint of, if you think about it from a fruit seller, right? One person sells apples, he sells 10 different types of apples, and that's it. You're like, but I want an orange. Like, well, I don't got one, right? Why not buy an apple? Because that's all the product they have to offer. And a lot of times people will, from a general public, right? Everybody is looking for insurance, but they want the cheapest all the time, right? How does that work exactly in terms of, because sometimes you'll find State Farm may be cheaper, maybe Allstate is cheaper, but if I go to you, you may have other different products that they never even mentioned.
Well, there's a lot of difference within the contract, because the long and short of it is an insurance policy is a contract between the carrier and the insured, the purchaser of the insurance. And each of those contracts or policies have got terms and conditions, and they can vary widely. What coverage is included, it has to be added by endorsement for specific needs, like a builder's risk, or deduct simply the limits and deductibles, where you find that we're going to insure it to its purchase price, where that may not be the best tactic because the purchase price and reproduction cost or replacement cost could vary wildly based on where that location is.
Right. And not every time one solution does not fit all, meaning you're not going to always have one company that's going to be cheapest about everything.
Very unlikely.
Very unlikely. Okay. So I know we made lots of notes because there's a lot to cover here. Some of it will be technical. Some of it will be not so technical. So let's get started. So where do we begin?
So, there's a need for in this marketplace we're talking about for the investor for hazardous insurance, and that's something you might some terminology you may see from your lender. And there's three categories of that. That's property insurance, essentially. But in this environment, we're talking about either vacant, rented or occupied, and under construction or rehabilitation or renovation. And that requires specific, each of those different policies or conditions requires a different set of underwriting criteria and a different kind of policy. But in order to determine what you need, you have to determine where you are in that cycle. If it's vacant, or if it's occupied, or if it's going to be renovated.
So let's kind of break it down in investor lingo, right? So if I'm buying a property for a flip, right? I'm buying the property. The day I buy it, obviously, it's going to be vacant in most cases, right? Or it's going to be vacant in a day or 2 or 10 days. Then there's going to be a period of rehab. And then I'm going to be selling the property. So that's going to be a vacant policy. Is that correct?
That's not correct. Initially, you might think it is vacant because there's nobody living there.
Right.
But because it is under renovation, that would be considered a builder's risk.
Builder's risk policy.
And that provides extra coverages for the exposure of under construction, theft of building materials, most particular. But a vacant building actually prohibits occupancy.
Got it.
If you have a vacant building, say if you have a larger building, say a strip mall, and it was vacant, and then one by one you get tenants in there, but you had a vacant policy on it because it was vacant and for no longer than 30 days, you need to get what's referred to as a vacancy permit from the carrier to allow for them to say, okay, we know someone's in the building now occupying whatever they do. Right.
So vacant is, like you explained, in a strip mall, whole thing is vacant. I have to tell my insurance company, hey, it's vacant. And then let's just say there's 5 shops there, one by one, I'm filling them up. As I fill them up, they will basically change the policy to say, okay, now shop number 1, 2, 3 are filled up and 4 or 5 are still vacant.
Correct. And there's certain carriers will accept that vacancy permit and provide you to say, okay, we understand, thanks for the heads up, and they continue on. Once it gets to a point generally of 75% occupancy, you would turn that policy into more of a permanent policy or a business owner's policy for that environment is called a lesser's risk.
Got it.
Policy for a fully occupied building. They understand that there's going to be a vacancy in a
Sure.
unit,
Right.
but the threshold generally is 75%.
About 75%. So basically, effectively, if I'm doing a flip, I'm buying a builder's risk policy.
That would be correct, yeah.
Okay.
Yeah.
So builder's risk policy, we understand it from new construction, right? That when you're building something, you're buying a builder's risk policy during the time of building. This is kind of the same thing. You're buying a property, it's going to be fixed, so it's under construction, right? And so at that point, so is it kind of, if I made a generalization, that generally when a property is being fixed, right, your risk is kind of the highest? Somebody can get hurt on the job, something can happen, people can break in, like all those sorts of things, versus the next stage, maybe if it's just plain vacant, versus when it's occupied.
Well, vacancy is probably the most highest exposure because it's vacant. In fact, if you do have a vacant policy that for whatever reason it sits for a long time before construction starts, generally 30 days or more, that's the need for the vacancy. Those carriers will put a sublimit on vandalism or theft of copper.
Got it.
So you may have $400,000 on this structure, but you may have a sublimit of theft of copper of $50,000 or $25,000, or maybe a much larger deductible for that peril.
So
you
basically,
need to read the policy and the conditions.
Got it. So basically, you have a large house, let's say, and there is a severe flooding. Something happens which is very, very severe. And if there's a sublimit, that can put you in a very precarious situation financially.
Correct.
Okay, so that needs to be read. Okay, so you're saying vacant will generally have the highest risk, hence exposure, meaning the premium is going to be the highest. Then generally it's going to be properties that are under construction.
Right.
And
so
then
not only the premium will be higher, but the terms will be different.
Okay,
And they'll be much more limited under a vacant building. There's different threshold of coverage. Broad, basic, special. Basic, broad, special. Generally, they're not going to offer that. The special is the terminology formerly was called all risk.
Got it.
And generally, you're not going to be able to get that on a vacant building, nor are you going to be able to get replacement cost on that structure. So you have to calculate its depreciated value.
Got it.
There's a real important feature or condition under any kind of property policy. It's referred to as coinsurance. And the insurance company requires that you insure it to either 100, 90, or 80% of its replacement cost to get replacement cost. Now, and even on an actual cash value, the same applies. So you may say, I only bought this property for $100,000, but the property to reconstruct it is $400,000 just because of the opportunity you came across, and the actual cash value is actually $200,000. But regardless, I only paid $100,000. Well, you can't insure it for $100,000 because you're going to become a co-insurer. If there's a smaller claim, say a $40,000 claim to the roof, you're in for 50% because you're insuring it to 50%. So that $40,000 claim, you're only going to net $20,000 of the coverage.
Got it. Okay. So a lot of times what will happen is, let's say I'm buying a property, right? Like currently, this is something that I'm going through, where I'm buying a property. It's a multi-unit building, and it has basically one of the things I know you're going to bring up a little bit later is electrical wise, it's got that Pushmatic, the main panels.
Yep.
Of course, we're going to upgrade those from a safety perspective because I don't want to take a chance.
Well, and that's generally going to be in the environment of the occupied building.
Got it.
So if you got a 2 or 3 flat, they were typical in 2 or 3 flats, or single-family homes that were built in the late 60s, early 70s. There's a number of different Zinsco, Pushmatic, Stablock. That's the brand name of various electrical panels that were essentially the push-button the breaker system, as opposed to the click back and forth that we're all kind of familiar with. Those were designed actually to be primed every month, which of course never happened. So now they don't work anymore. They're
Prime
50,
meaning
60.
basically tested every month.
Somebody had to go down to the panel, went down there and hit it and click it on and off just to keep it nice and lubricated, and that never happened. So if you have or looking at a property that has that those panels in them, you're going to have to immediately replace them. So that you need to, be aware of it from an insurance value or perspective. B, realize you're going to have some immediate costs to change out that panel.
Got it. So that was for a fix and flip, right? Then let's say with a rental property, a lot of our people do rental properties where they're buying the property, they're going to fix it, and then they're going to keep it. 2 different types of insurance when I'm during the time of phase of fixing it, then getting it occupied.
Sure.
And then, so it's going to be 2 different.
It's exactly right. There'll be 2 different stages. We'll do a builder's risk. Again, that's on the property insurance side of it. But we haven't touched on the liability side of it. So it was a perfect opportunity to talk about that. So as a property owner, if you buy this building in your own personal name, or maybe you set up an LLC, you personally or that LLC has got an exposure for the premises, meaning the area surrounding the property or the property within. And you need to purchase liability insurance. Generally, it's attached to the builder's risk policy. Sometimes it'll be separate depending on the conditions of the entire situation. But the liability is a very important component. Some people will create a small general contracting outfit for themselves and then GC it to themselves. So I do Pat Inc. as my GC, and then I have Pat LLC that owns the building. Well, I've created now a general contractor environment, which opens up a Pandora's box of an entirely different set of liabilities.
Got it.
Which I don't think we have time to get into there. But be aware of the fact that they're not one and the same.
Got it. So basically, let's just say LLC 1, you have the asset in that, and then you have LLC 5, let's say, that's your GC LLC.
Right.
Right? And your GC LLC is doing work on your LLC 1.
Correct.
And an incident happens. Somebody cuts their thumb, right? Something happens. Somebody gets hurt, right? Now, as a building owner, you're covered. But as a GC, unless you have actually bought the proper policy, right, you may think, well, yeah, but it's okay because I have insurance on the building. That's fine. But do you have insurance as a GC?
You do not unless that GC entity get it.
Exactly.
And there's a couple sets of liabilities that you have to contemplate on the GC level.
Sure.
Because it provides coverage for the premises, which is you're going to get on the landlord level.
Right.
But also products and completed operations. Completed operations is a construction environment coverage that protects you for what took place while it was being done. Some will say, well, it's all right, all my subcontractors have insurance. Well, that's all well and good, but if one sub hurts another sub, the ladder falls over and knocks over, the painter's ladder knocks over the electrician's insurance company is going to go to them, and they're also going to come back to the GC. So
got
you're going to need a liability policy to protect you for what goes on within that environment.
Got it. Makes sense. So the next thing you had on here, so that we follow kind of our list, right? Because there's a lot to cover here. Underwriting criterias. Explain that. You had things like age, condition, construction, protection, safety. What does those points mean?
So in the vacants, the occupied, and certainly under the construction, the insurance companies want to know on the front end, all right, what condition of the and age of the structure we're talking about. What are you guys going to do with respect to protection? Are you going to have? They will require many times fire extinguisher be placed in the construction environment. In the event something happens, we can put it out, and someone just doesn't run out the door and let the place burn.
Sure.
And of course, safety. We want to make sure that is the place properly secure at night, so they don't come in and remove all your building materials after you leave for the day.
Makes sense. So now let me ask you this. What about, let's say somebody buys a property and then they're doing work, but they do not pull permits and somebody gets hurt. Can that be an issue? Can your claim be denied based on that?
Well, the contract of insurance is exactly that. They all have conditions. Probably the biggest issue you want to is protect yourself, because you want to have a carrier that is going to respond to that liability exposure. I can't say definitively whether one policy will say you must have a permit or not, because you can't read all the policies and be prepared to answer that question. But certainly, from an underwriting criteria, the underwriters will ask, are you doing everything according to permit?
So the next thing was, we kind of touched on this a little bit, and that was update HVAC, plumbing, electrical, and roof.
Right. Well, particularly in the occupied environment, where you're going to maybe do some cosmetic work on the building, and then go from there. Then now the insurance company's accepted the risk. They're going to want to know how old the HVAC unit is. Do you have current circuit breakers? Or do you have any of those pushmatic items? Galvanized piping has become a very serious issue for homes built in the late 60s, early 70s, because those galvanized piping are under pressure. They're supply pipes, and they're rotting from the inside out. They only last so long. So if something pops, it's going to create a claim.
Got it. So basically, all those things are going to matter in terms of what is the cost of insurance and who will insure it also?
Both. Yep.
Both. Okay, got it. And then you had, I know, already touched on, because in the Chicagoland area, because this is going to be kind of area specific, we have a lot of properties. I mean, majority of our inventory, 60, 70, 80, 100 years old. I mean, that's no big deal. Not that
old anymore.
Right? That's not that old, right? But in the Chicagoland area. So is this, some of it is area specific?
Absolutely. I work within the Midwest market.
Sure.
There'll be other concerns for coastal properties, infestation issues,
Sure.
Flooding issues, wildfire issues. So, in this marketplace, at least the Chicagoland area, let's call it the Midwest, the concerns are roofs. There have been a number of hailstorms of late that has the underwriters very concerned and very sensitive to how old a roof is, and can it handle a storm, essentially, and the average updates of the building.
Yeah, and I mean, I've had a property where they flat out, they gave us a quote, pretty good quote, and then they denied it. And I'm like, why would you? No, we don't want to cover. Oh, no. And I couldn't. Finally, we got to the bottom of it. Something to do with the roof. I'm like, it's got a brand new damn roof. They're like, no. I'm like, no. Here's the receipt. Here's the pictures. Right? I actually had to go out and prove it. That hey, we're not just making it up. It truly has a new roof on the property. But one insurance company, they just wouldn't listen. So but that can be an issue.
Well, yeah. There's ways within the policy to rectify a disagreement. That's one of the reasons you have an agent. That's part of the process. Is this guy is your advocate with the insurance company? Again, some of those direct writers ask the agents not to participate in the claim process. They say we have claims people, let them handle it. So each of these different purchasing environments have got different levels of service. So you may have to fight your own battle.
Got it. So the next thing was, as far as galvanized pipes, you talked about sewer backups or water damage.
Okay, so water flood is a big word. All right, surface water is flood, and surface water it traditionally is not covered under 95% of the insurance policy. Some portfolios will offer some flood with a sublimit, but for the most part, you can convince yourself that flood, surface water that enters from the surface, you need to go to a specialty flood policy provided by, there's certain carriers that will compete against, but provided by FEMA.
Got it.
But water sewer backup coverage, that's a different line item. That too is a sublimit. Some carriers will offer $5,000. Some carriers will offer $5,000 mechanical only, no personal property in the lower level. Some will offer broader limits than that. Some may require automatic battery backups or alarm systems or any combination of those mitigation devices to put a handle on it.
Got it. So now, this is kind of a confusing topic, right? Because sometimes whenever people will talk about a sewer backup, water backup, they throw all of it into one, right?
Well, I'll add one more. A plumbing issue. So if a plumbing pipes, a galvanized plumbing pipes, and it flooded the basement, well, that's not a flood. That's a plumbing loss. And that's covered under the perils under a standard policy.
Got it.
So there's actually 3 levels of water.
3 different levels of water. So this is kind of common in some areas of Chicago. It's gotten better, but it's kind of common. Like Berwyn is an example, or Oak Lawn. There used to be parts of Oak Lawn where when you have a lot of rain in an hour period, 2-hour period, they just could not take in any more water. So they would just shut off all the water take-ins, right? So now what happens is even properties that should not flood would flood. That's not because your sewer backed up. It's just that the city is not taking in any water. What happens in that case?
Well, that's, again, the definition within the policy is water that backs up through a sewer or drain.
Got it.
The reason of it is superfluous. It backed up through a sewer or drain, and that's where the coverage is triggered. And it coverages that line item coverage that you bought by line, or it's got a sublimit built into the policy.
Got it. So basically, if the water came in through your front door or through the your kind of English window well, right? That is not covered.
No, that's flood.
That's flood.
That's surface flood. That's just a bad storm that went all the way up the front lawn and in the front door. That's flood. And that's not covered under the standard policy.
That's not covered. So basically, for that, you need a special policy.
Correct. And you can check your property. You could simply Google the address flood zone, and it'll provide you a flood zone or a flood map, and you can actually see pretty clearly where the flood risks are in the area for which you're considering to purchase a property.
Sure.
And you could buy a policy from FEMA. There's an immediate effective date, I think within 6 days of a real estate closing. Other than that, you have to wait 30 days for the effective date. You can't buy it essentially when the storm's coming.
Got it. That makes sense. So the next thing you were talking about, and it's kind of going back a little bit to what we started with, that triggers 2 questions in my mind. So let's deal with the builder's risk first. And you have notes on scope of renovation.
Right.
And you had 3 things written down: cosmetic or load-bearing walls.
Right.
Explain that.
So the underwriters are concerned of the scope of the work that's going to be done on any given project. Typically, it's cosmetic. We're going to paint it, replace the carpet. We're going to update the kitchens and baths, some lighting, maybe some light electrical, and that's considered to be cosmetic. Load-bearing walls is exactly that. Are you moving a load-bearing wall? And they want to be concerned that whoever's doing this work is qualified and understands the engineering process behind moving a wall, because they don't want it to collapse for obvious reasons. And then the other, similarly, is a second story or a room addition to determine whether or not it's properly been engineered. Can the roof actually sustain a second story addition?
Got it. So basically, that's going to determine how much your premium is going to be,
and whether or not that coverage is going to be available from that carrier at all. They may not have an appetite for someone if you're moving a load-bearing wall. No, thank you. We choose not to offer you price.
Got it. Then you have additions and second stories. Similar sort of thing.
Same process, yeah.
Okay, got it. So why is it that sometimes, I mean, from a consumer's perspective, it's hard to understand that sometimes I may go to one person and they're like, that's pretty reasonable. And then you go for the same exact building to another person and it's $600, $700, $800 higher. Why is that difference?
By person, you mean agent or carrier?
Agent or carrier.
Yeah. Well, because different carriers have different appetites, and they move in and out of the market. They may find, just like any other business, people come in. They product development within the insurance company says, "Hey, this is an opportunity.
Sure.
We're going to build this out, and now we're going to get aggressive in it." They may have some adverse experience over a period of time, a couple of years, and say, "Well, essentially, we lost money on this product line. We're pulling back."
Got it.
And they do that by two ways: they raise the price up, or they tighten the underwriting criteria up and say, you only this much. Right now, in the standard market for regular homeowners, residential homeowners, there's many carriers out there that says don't even submit the application if the roof is 10 years or older. We're not interested in it.
So they won't even underwrite that policy?
They won't even look at it.
They won't even look at it. Okay. So I remember the first time I met you, and we were kind of going through this phase at the time where I don't know if it was Allstate, State Farm, one of the big ones. They were perfectly fine insuring a property under an LLC. And then suddenly they're like, well, we really can't insure it under the LLC, but I don't know if it was a wink, wink, nod, nod kind of thing. But we will do it under your personal name. And the quote unquote, the loan company, right, the mortgage company was okay with that.
Okay.
And I don't remember if you remember that conversation or not. And it just happens to be you were here, Sandra was looking for kind of other options, and you come into the picture. So let's just use, I think it was State Farm that did that change. And then they're like, moving forward, we're not going to insure you in the LLC name. But the LLC is the owner of the property.
Well, and some people will attach what's referred to as an additional insured endorsement
Right.
Onto that chassis of the policy that
Sure.
is in an individual's name. And that language within that policy is not the same as being a named insured. And named is in all capital letters. And because the named insured is afforded all the privileges of the policy.
Got it.
An additional insured is provided coverage specific to the language of the additional insured endorsement. They're not the same.
So that is something I did not know.
Yeah.
So that when you say somebody is additionally insured, that the coverage on that may have a much lower limitation, much lower coverage than somebody who's the named insured.
Correct. The scope of the coverage is going to be limited within the language of that additional insured endorsement. And there are literally hundreds of additional insured endorsements that read a myriad of ways and different edition dates of that same endorsement.
Got it.
Filed with ISO, and ISO is the insurance service office that publishes all the paperwork for the insurance world. So it could say you're totally covered, or it could say you're barely covered, anywhere in between.
Got it. So is that kind of the fine print in the insurance policy?
Most definitely.
Got it. Because that was a big concern of mine, because I'm like, do I really want to be buy all these policies under my name, and then something happens and I'm up the creek?
Well, I agree with that, and it's a concern because we live in a litigious environment.
Right.
There's ways to, as we talked about, there's liability components that you put under the initial policy. We talked about the general contractor component that opens up a Pandora's box of not only general liability but workers' compensation in the state of Illinois. But how much is enough insurance? Generally, those limits are at $1 million under a package policy or a builder's risk policy. But there's another a coverage called an umbrella. An umbrella, it gives you the idea it goes over everything. Well, it doesn't go over everything. It doesn't go over the property. It's a liability coverage, and it provides you a catastrophic limit in excess of the underlying policies that you schedule to take care of a very serious incident. If, for instance, if you've got a property that is under rehab and some kids are coming down the block and they want to go see what's going on inside, and down the stairwell he goes and he's seriously injured, you're going to want to have proper limits of liability to protect yourself, your assets, and the asset of that entity that owns that property.
So before we move on to umbrella, Patrick, right, I want to come back to kind of a topic that we were just talking about. And that was, I buy a property, it's in, let's just say, LLC 1, and I'm the owner of the LLC. State Farm says to me, hey, we're not going to insure it in named insured, right, under LLC 1, but we'll do Andrew Holmes and put LLC 1 as additional insured. Something happens. Somebody gets hurt there. Now, even though the legal owner of the property is LLC 1, when I have to basically, whoever gets hurt or whatever, their insurance company or the attorney is going to come calling basically my insurance company, right? And they're going to say now Andrew Holmes as the insured on the policy. So now when they file a lawsuit against you, now it's not just against the LLC 1, you may get personally named in that. Doesn't that open you up to another whole level of exposure?
Absolutely. Now, this is not to say that accommodations aren't made within my industry.
Sure.
And it's important that you review the application of insurance that you submitted to the carrier, make sure what was disclosed, make sure it was signed, because the application is part of the contract.
Right.
And if they made an accommodation and say, we're going to put this in your name and then we're going to name additionally insured, and it's our intent to cover both Andrew and LLC 1, so be it. But
the fine print matters.
The fine print definitely matters, and when they hand that file over to their defense attorneys, that guy may have an entirely different perspective.
Yeah, and he's going to parse every word.
Well, he can,
Right.
whether they do or not. And,
Right.
Again, accommodations are made, underwriting files are reviewed. What was the intent? I can't say how that's going to shake out, but
Sure.
is it a concern? Most definitely.
Got it.
What you want to do is make sure that the entity that owns the property is the named, capital letters, insured.
Got it. Okay. So I just wanted to, because that's an important point. So the whole point is, and there's no black and white answer for that, right? It's, you have to read the policy if you're kind of deviating from the basic standard way of doing things.
That's correct.
Right? Okay. So now let's talk about the whole umbrella thing, right? It's one of the most misunderstood kind of things about insurance. Most people will set up entities all over the world as if they're some sort of American Airlines, some crazy company of trying to run from liability, right? I don't want anybody to find out what I own, which is impossible today, right? Yet they will not buy umbrella policy, which is probably one of the most cheapest things, right?
I agree.
To kind of cover you. What exactly? So let's just say I'm an individual. I own a house. I have a couple cars. I'm married, a couple kids. And I earn decent amount of money, right? Should I have a little bit of umbrella coverage?
Most definitely.
Okay.
Yep.
What does that do?
So an umbrella provides you an extra layer of limit of liability, generally in $1 million increments, over and above the scheduled underlying policies. And in a personal insurance environment, be your homeowners, any recreational vehicles, any personal vehicles, and maybe any secondary residence, that kind of thing. And you would schedule all those. They all are required to have a certain minimum limit of liability, generally $300,000 or maybe $500,000. And then that umbrella policy would pick up in the event of a serious loss. God forbid you hit somebody on a bicycle and they're injured for life and in a wheelchair, et cetera, need a great deal of care. That's going to cost. It's going to be litigated, and it's going to cost the insurance company the limits of liability on the policy, most definitely. And without an umbrella, that next layer of liability for that is going to go into your personal assets, and that could be your home and your business or whatever else they can attach. That's not up for us to decide. It's not for the insured to decide. It's not for the injured party to decide. It's for the court to decide. We have no idea how that's going to play out.
Got it. So a simple example would be basically somebody has a good job, spouse has a job, they get into a car accident, right? Most people, even with a car accident, they think that they have a good policy. They never review what the limits are on the policy, right? Let's just say it's $100,000. right? What is the state minimum in Illinois?
It's I believe it's 20,000 per person bodily injury, property, 40,000 per any one accident, and 15,000 property damage. I might be a little shy on those limits. I haven't written a minimum limit policy in my entire 40-year career. So
Got it.
I'm working off of maybe some old data there.
Right.
But
Okay.
Our criteria in my office, no less than $500,000 and an umbrella offered.
And umbrella offer. Okay. So because what becomes from a practical standpoint, right? And this is something that happened to somebody within Mastery, within our group, where literally the guy's making a turn, kid comes 80, 90 miles an hour on a motorcycle, right? This person's never had a ticket in their life, like one of those people who's safe driver, right? And the kid hits him, runs the red light, hits him, is gone on the spot. 20-year-old kid, right? I don't care who you are, how fast the kid was driving, think about how that looks in court, right? Who is the sympathy with? And guess what they were after? This guy had 20, 25 properties at the time, did not have an umbrella. Now, you can't prevent the accident. When it happened, I couldn't talk about it at that time, obviously. But an umbrella policy doesn't take care of the problem, right? The problem is what it is. You got to deal with it, right? It's called an accident. Fortunately, he didn't even get a ticket for it because he followed all the traffic rules, right? But he had a sword hanging over his head. Mm-hmm. And if he had a $2-3 million, $5 million policy, right? I mean, what is the cost of that?
Oh,
right?
The cost of it.
$1,200.
Yeah, $400 to $700. It depends on how many toys and such you have, cars and youthful drivers, that kind of thing. Everything is rated by component.
Right.
But $500 in a round number.
Right.
It's sleep insurance.
So, I mean, it just and that was exactly my point, and we've been talking about it for years. Is that you know what it buys you? It buys you peace of mind, right? And for a couple $1 million policy, so it covers you have car insurance. On top of that, it's like a bigger umbrella, which just buys you a little bit peace. And to me,
and it buys you that being a responsible individual to say, I want to be a responsible person. A lot of people will come to me on a commercial level and say, how much umbrella do I need for my business?
Right.
And the criteria there is subjective. It's, well, first, who's requiring it? Is it a one of your customers requiring you have to have X amount? Is it a municipality that says to work in this town you have to have X amount? Is it a bank that says if you're going to borrow money from me, I want you to make sure you have this kind of insurance?
Right.
How much assets of your company or your personal assets in the same discussion are you trying to protect?
Right.
And the last of it is what kind of citizen you're trying to be. Do you want to be responsible?
Right. No, I mean, to me, from the biggest standpoint, I mean, I got into a car accident, right? Brand new car, $150,000 car. I get into an accident, the guy lost his wheel, not even my fault. But guess what? A year later, there's a lawsuit, right? And there was somebody with me in the car, even though I was not at fault, right? This person broke a couple ribs. That was that, right? Nobody actually got hurt severely. Car was totaled, but I mean, I'm pulling him out literally here on 294, and I'm like, oh my God. You know, literally 3 weeks before that, I had bought a $5 million insurance policy, right? And it was just like, okay, thank God, at least I have additional coverage, right? And that peace of mind was 100 times worth it.
Right.
Because a lot of times people think that, oh, I don't have a lot of assets. All I have is a job. All I have is my house and a couple of cars. That's one thing we always insist. $1 million policy, right? If you don't have crazy toys, if you don't have crazy things, $300-$400, right? I mean, $450, $500 tops.
Well, there's another component of a personal umbrella that is real important to consider too. It's a little selfish, but it is what it is. Some carriers, not all carriers, but some carriers will allow you to buy a sublimit. Say if you have a $2 million umbrella, it'll allow you to buy a sublimit of uninsured and underinsured motorist of $1 million on your umbrella. And that protects you in your car in the event that you're injured.
Right.
This is not third-party liability. This is protecting you in an uninsured or underinsured vehicle. So, and I think we could all readily understand that in today's environment, you could get T-boned by a guy who stole a car, and you could get injured. Yeah. Your own policy would respond to that uninsured situation.
Yeah.
To the tune of $1 million.
Or even underinsured.
or underinsured.
or even underinsured. Like in my case, it was a brand new car, right? I had, like a foolish person, made all the lease payments up front, thinking I'm wise. I don't have to worry about lease payments. I paid all of them off, $50,000, $60,000, whatever it was, right? And guess what happened?
It was, yeah.
Zero, right? Because anything over $115,000, however the lease thing works, right? Basically, Chase wrote it off, whatever the insurance company paid up to a certain limit, and the rest of it, I'm like, what about my money? And I called the attorney. I'm like, hey, sue this guy. He's like, Andrew, he's in a car that loses a tire. What do you think is his financial well-being?
Yeah,
right? And so obviously he was underinsured, and guess what? It is what it is.
Yeah.
So it's one of those things that, to me, it's probably one of the biggest things to buy you peace of mind is just buying a little bit of an umbrella.
Yeah.
Is there a guideline you guys suggest to people that how much of an umbrella you should buy based on is it based on your net worth? Is it based on, what is it based on?
Well, it's based off a lot of the things that I mentioned earlier. Your personal assets and what you're trying to protect and what you think your exposure are. It is, if you got a lot of toys, you got teenagers and wave runners and snowmobiles and that kind of thing, you've got a larger exposure. It's a subjective number, so you can't, there's not a formula you plug in and say, hey, you have this and that should be enough. You got to feel good. Then you look at the price and say, all right, for $4 million, it's $600, and for $8 million, it's $1,200, somewhere in between. You make a business decision in your own household.
Got it. So generally, at least what we suggest, right? And this is just, I'm not a lawyer in this case. We always suggest 4 times your net worth, right? Now, obviously, if you have a lot of rental properties, you have a lot of equity in it, right? Do your own math. But if you have 10, 15, 20 rental properties, we have a ton of people that have 20, 30, 40 properties, right? And they don't even have a single umbrella.
Well, in each of those entities, it all depends on how it's structured.
Absolutely.
Whether or not you can include all those entities under a single umbrella. You're buying umbrellas each and every time. And a function of net worth is assets versus liabilities is X. And if you've got you don't have any equity yet in a property, you still have the exposure.
Absolutely.
So I don't know that there's a formula that you can plug in there. You can say, you have to protect what's in my bank account. That you can put your finger on.
Right. That makes sense. Okay. Next thing was anything else on the liability side?
Well, the liability side, we touched about it a little bit. If you're acting as a general contractor, if you're an entity acting as a general contractor, about workers' compensation. Workers' compensation is required in the state of Illinois for any employer. So your subcontractors that GC is going to hire for LLC 1 to do the work has got an exposure for those subcontractors. And if those subcontractors are uninsured, that liability is going to funnel right up to the GC, both on the general liability side and on the workers' comp side. Far and away more common it happens on a construction site is workers' comp, and that's, again, a mandatory requirement. So if you're going to hire subcontractors through a GC, or frankly, even if you're going to hire the direct contractors as an owner, you would want to get a evidence of insurance or a COI, certificate of insurance, that evidences that they've got that trade is carrying a proper insurance. You take it a step further, which I fully recommend, that they name you additionally insured. So in the event that you as the owner get wrapped up in the ladder toppling over on the electrician, the painter's ladder who went over, his policy protects you, the owner, because you had nothing to do with the ladder. He's the way it said it there. However, if the reason the ladder went over is because there was a hole in the floor that hadn't been properly covered, and that's not the responsibility of the painter or the responsibility of the electrician, that's going to fall back on the owner. So that's why you want some liability.
Got it. Okay. Makes sense. As far as this is kind of maybe a little bit out of the set of questions, but this is a big thing. I have, let's say, a small fire in the property, or I have some damage, or when is it the right time to file a claim, and when is it not the right time to file a claim? Is there such a thing?
Well, there isn't such a thing. It's really it's your risk tolerance. Okay. I encourage you, if you do, and we've had this conversation, you and I, if you do have a higher risk tolerance, say, give me a larger deductible. I'll save whatever little premium savings I can save along the way. I'll bucket that in at least in my head, and use that to take care of these nuisance claims, a broken window, and that kind of thing. Because if you utilize an insurance policy as a maintenance policy, you're not going to have a very long relationship with that carrier. Sooner or later, they're going to separate from you.
Got it. And a lot of times people have this idea, which they think that, if just because you own a lot of properties, right, you can just, anytime there's something happens, just file an insurance claim, right? At least this is my policy has always been is we do not file insurance claims on $10,000, $12,000, $15,000, even though my deductible may be only $5,000. Right? If it's something manageable, right? And manageable for everybody is going to be a little different.
Exactly right.
It's a different number. But for me, if it's manageable, we are not going to file a claim, right? We're going to deal with it. We're going to absorb it as a cost of doing business generally, because I feel that in the long run, it's going to come back to bite me if for small things I start filing claims.
And you're correct in making that assumption, because ultimately it will, and the cost of buying this product and running your business will get more expensive. If anything, you could look back and say, okay, what is there a pattern that is why are we having these kind of things? And you have to run your business and to try to mitigate those issues.
Sure. So is there such a thing? So let's say I have 15, 20, 30 LLCs, right? Different LLCs. And whenever I ask for insurance, right? Let's say in LLC 5, right? Is there such a thing that I come to you to give me a quote on XYZ property, that even though I'm not the owner of the property, it's the LLC that's the owner of the property. But hypothetically, let's say I have 3 claims under my name. Can that affect the pricing of the policy on the LLC?
Generally not.
Okay.
The carrier is going to ask for loss runs or a history of claims for that LLC for 3 to 4 years, depending on the carrier and their appetite and what it is. And they'll also ask, are you involved in any other entities? And that's really more gauged to say, are we insuring what we think we're insuring? We don't want to piggyback, because the language within the liability section is pretty broad, and they want to make sure that they know what they're on with respect to what they're providing coverage for. But if you have separate LLCs, that entity should stand on its own and one of the reasons, and I'm an advocate of that. It may be redundant, it may be extra effort, but I like to silo all the LLCs. So if you do have an issue with an LLC, it doesn't have a adverse effect on the others that are running fine.
Got it. And then as far as another thing that comes up when I think about just in general liability perspective, right? Generally, the policies we're buying is on a rental property. Let's say the property's worth $300,000, right? And we get, I think, $1 million liability, right? That's what at least I understand. I mean, what if the property is worth $600,000? And I want a little bit more. Can I buy a little bit more?
Some carriers will offer a $2 million.
Okay.
On the package chassis.
Got it.
They'll offer generally $1 million or $2 million. Some carriers they won't. They'll just that's what their comfort level is. Then you buy an umbrella, which should be similarly priced if it's just a single unit, and that's how you get more protection.
Okay, got it. So I can always up that if I feel there is a need.
And you can go outside of that carrier. You can go get an umbrella off on its own. It's a standalone. It might be a couple dollars more, but you can go out and buy it in the marketplace and say, I'd like an umbrella for this property alone, because X carrier didn't want to offer me any more limits.
Got it.
And you could find someone to write that for you.
Got it. X property or the ABC LLC.
Correct.
Right.
Yeah.
Either way, you can buy it.
Yeah, you want to make sure that the named insured, back to the capital named insured, is the entity.
Okay, got it. So let's say I have a claim, like something happens to my property, gets damaged, whatever. Who should I be calling?
Well,
do I call you as the agent, or do I call the insurance company?
In the independent agency environment, which is where I live, you would call me.
Okay.
We talk about it. Say, is what happened? Is is this worth turning in? And that way I can make sure it gets assigned to the carrier, the adjuster gets assigned, you get connected to the insurance company, et cetera. There are people in my industry, in my environment, that say, no, here's the insurance company's number, go ahead and make a call, take care of it yourself. That's just not our philosophy. In the direct writer world, I believe they encourage you to call the insurance company direct because they, in fact, are the insurance company. They may be a franchise location, but they ask you to call them direct. Certainly on the online environment, you do it all yourself.
Got it. Okay. So basically, for me, I should be calling you on all the policies we have with you.
I would hope so.
Got it. Okay, perfect. So just from a review standpoint, what is it that is different that an independent agent like you can offer to the general public?
Well, service is probably the main thing that we pride ourselves in, is to be able to be an advocate for you with the carrier in the event. I don't work for the insurance companies. They're a supplier to me. I work for you. So my obligations are on your side. Certainly I can interpret an insurance contractor much better than you can. You can interpret a lease much better than I can. Sure. So we all kind of stay in our lane, and I do. That's my service. And the other thing the independent agent versus the others is choice. We've got different carriers. We're not married to a single insurance company that could move in and out of the market and ebb and flow with the market. We pay attention to new entrants in the market and say, hey, look, here's this carrier. They're aggressive. They want to write this kind of business. Let's start looking at these guys. We can, long and short of it, choice.
Okay. So you could, but does it mean that if I go to you, that every time I'm going to get the best policy but the least premium?
Well, it's my mission is to get you the best terms at the competitive price.
Okay.
Which may not always be the cheapest price, but it's we focus more on the terms than we do on the price. The price has got to be in there, otherwise you're not going to be satisfied with me, and our relationship won't be long lived.
Got it.
But the terms are our priority.
Got it. Okay. So the overall package. That's what
we're trying to protect you because we know a little bit more about this world than you do.
Right.
So and we know what it should cost.
Got it.
If it comes in too cheap, there's a reason for it. There's something missing.
Okay. So we covered kind of a lot, right, of different things, and this can be a confusing subject. If somebody wants to know more, somebody wants to reach out, how do they reach you?
My office is in Oak Brook. My office number is 630-468-5400. You can seek us out online at
Just repeat that one more time slowly.
Sure. 630-468-5400. And our website is ScullyInsuranceGroup.com, and that's SCULLY, Insurance Group, all spelled out, .com.
Okay. ScullyInsuranceGroup.com. And this is a business you started?
Oh, my grandfather started.
Oh, wow. Okay.
Since 1928. We're coming up on our 100th anniversary, and in our office we have my son and niece who are part of the fourth generation.
Wow.
Of Scully's doing insurance work.
Oh, okay. Wow. That's amazing, right? I don't see that many people in third, fourth generation in the same line of business.
Yeah.
Great.
I'm very proud of that.
Anything else we may have missed, Patrick?
I think we covered a lot of ground. Certainly, it's a broad topic. There's a lot of nuances to pay attention to. If I can encourage anybody is to not zero in on price, and that must be the best. Read the terms and conditions of the offer.
Got it. And in terms of types of insurance, you guys obviously do the standard stuff, the car policies, all that kind of thing, the regular houses, rentals. Sure. You guys do multi-units, commercial property, everything?
Yeah, we do. We're a full-line agency. We do personal lines, commercial lines, benefits. We're still one of the independent guys still doing benefits, reluctantly, I guess. That's a challenging world.
Sure.
Life insurance.
Okay.
So we try to provide a solution for any of your insurance needs.
Got it. Guys, you heard it. So this is Andrew Holmes with Cashflow for Life. This is a topic we don't really cover much, but it is one of the most important topics because I know nobody wants to pay for insurance, but when you need it, you're glad you did pay for it. So please like the podcast, share. That's how we get to grow. If you want to learn more in terms of real estate investing, you can always go to andrewholmesrealestate.com. That's andrewholmesrealestate.com, or go to one of our weekly meetings. Every single week, we do a bunch of different topics, meetings on different things, from foreclosures to financings to everything in between. Join us in person or online. Talk to you soon.